Hello, my name is Mayanka. I am accounts and a finance trainer from Uplatz. Today, we will cover the topic of financial modeling. We will cover this topic in three parts: part 1, part 2, and part 3. Today, in this class, we will cover part 1. In this class, we will discuss what is the financial modeling, how to it is useful, and how we will prepare financial model. And in this video we will also discuss a different type of financial model. So now we will start our video. Financial modeling part 1. What is the financial model? First we will discuss what is the financial model. Financial model is a task of building an abstract representation of a real world financial situation. The financial modeling is a task or it is a work. It is a work to prepare and to prepare a representation or to prepare a model so that we can present the real world financial situation. On the basis of financial modeling, we will prepare the models or we will prepare the presentation. On the basis of these presentation or on the basis of these models, the pictures of financial situation, the picture of financial situation can be present. The financial modeling is a mathematical model which is designed to represent the performance of a financial asset or portfolio of the business, project, or any other investment. The financial modeling is a mathematical representation. It is a mathematical presentation which is prepared or which is represent which is prepared by the organization or by the person to represent the performance of the assets, to represent the performance of the financial assets or portfolio of the business or project or any other investment. Is that on the basis of such a financial modeling, the person can perform the person can perform the person can perform or it can represent the performance of financial assets or portfolio of the business, project, or any other investment. A financial model is a tool that is built in Excel to forecast a business financial performance into the future. The financial model or the financial presentation is a tool which is prepared or which is built, which is made in the Excel on the basis of or to forecast the business financial performance into the future. Is that by the use of such model, by the use of such financial model, we can forecast the business performance. We can forecast the business financial performance for the purpose of future. So for the purpose of preparation of this presentation, we use the historical data, the historical financial data, and all other relevant information, on the basis of which we can prepare such a representation in the Excel. We will prepare such a representation into the Excel, and on the basis of such a representation, we can know about or we can estimate or we can forecast the business performance in the near future. The forecast is typically Such forecast is typically based on the company's financial historical performance. Such a presentation or such performance is Such a model, such a representation, and such forecast is totally based on the of the historical performance and require preparing the income statement, balance sheet, cash flow statement, and the other supporting schedule. It said if there is any organization which is want to forecast the financial performance of the enterprises into the future, then it will use financial model. It will use financial modeling, and such forecast is totally based such forecast is totally based on the historical performance of the organization, and such forecast is also required such a forecast is also required the preparation and the preparation of financial instrument, preparation of income statement, preparation of balance sheet, preparation of cash flow statement, and the preparation of supporting schedule. On the basis of these statements, on the basis of these financials, means balance sheet and income statement, the organization will consider or the organization will prepare a finance model into the Excel, and on the basis of these information, the organization can estimate or the organization can forecast the business performance. So this is only a format so that the organization can prepare the financial model. For example, they in the above row there is the historical result. There is the historical result. So in 2012, 13, 14, 15, 16, we have used some historical detail. And on the basis of these historical detail, we have forecast the detail for the year 2017, 2018, 2019, 20, and 2021. So, on the basis of previous or the historical data, we can forecast the position, financial position of the organization for the near future. So, for the purpose of this forecast, there is a requirement to prepare income statement. There is a requirement to prepare income statement because on the basis of such income statement, we can consider or we can identify or we can estimate the future inflows or the future expenses. There is a requirement to prepare a balance sheet because the balance sheet is also provide the financial data. Cash flow statement because the cash flow statement provide inflow and the outflow of the cash and bank balances and all other supporting schedules. So, in the case of financial model to forecast any of the data for the near future, preparation of income statement, preparation of balance sheet, preparation of cash flow statement, and supporting statement or supporting schedules are important because the forecasts are made on the basis of these statements or on the basis of these informations. What is the financial model which is used for? Now we will discuss what is the financial model. Now we will discuss what is the financial model which can be used for. What is the financial model which can be used for? So the output of the financial model is used for the purpose of decision making and performing financial analysis, whether inside or outside the company. Is that we will use the output of such financial model. The organization or the person will use the output. They will use the output of the financial model for the purpose of taking the decision. Because on the basis of such financial model, they can know about the or they can forecast the future performance of the organization. They can discuss or they can understand the future financial performance of the organization. And on the basis of this, they can take the proper decision. They can take the proper decision. and performing financial analysis, whether inside or outside the company, whether these whether these decisions are related to the within the organization or outside the organization. So such financial model is used by the person. So the financial model is used by the organization for the purpose of decision making and for performing the financial analysis. On the basis of this, the person can also perform the financial analysis, whether it is relating to the inside of the company or it is relating to the outside of the company. So this is the use of financial model. Inside a company, executive will use the financial model to make the decision. Within the organization, such financial model is used by the executive for the purpose of different decisions for or to make the different decisions. Number one, rise in the capital. Number one, to raise the amount of capital. Number two, making the acquisition of any organization. Number three, growing the business. To grow the business, the organization will use financial model. Number four, selling and distributing assets and liability unit for selling and the distribution of selling and diverting sorry, selling and diverting assets and business. Next, budgeting and forecasting. Budgeting and the forecasting is is also an important decision in the respect of which the organization will use the organization will use the financial model. Capital allocation. For the capital allocation, the entity will also use the financial model. And the last is value of business. For the purpose to determine and to discuss the amount of value of business, the will also use the organization will also use financial model. So for the purpose of raising the capital, for making the acquisition, for growing the business, selling and divesting assets and business units, budgeting and forecasting purpose, capital allocation purpose, and valuing a business purpose, the business model is used by the organization. So, how do you build a financial model? Now we will discuss how to build or how to prepare a financial model. How we will build or how we will prepare a financial model. So, so now we will discuss how to prepare the financial model. Now we will discuss how to prepare the historical modeling. Now we will discuss all the steps. We will discuss all the steps how to start and how can understand the building of a financial model. The financial modeling an interactive process. If you say interactive process, now below is a step-by-step breakdown of where you should start and you can understand how to build financial model. Now we will discuss how to prepare financial model step by step so that you can understand the preparation of financial model. Number one, historical results and assumptions. Number one, for the preparation of financial model, first we will consider all the financial results and all the assumptions. Number two, start the income statement. Then prepare the income statement. Number three, start the balance sheet. First, prepare the income statement. Then prepare the balance sheet. Next, build the supporting schedules. Then after, prepare the supporting schedules. Complete the income statement and the balance sheet. Next, build the cash flow statement. And then after, perform the DCF analysis, discounted cash flow analysis. Add sensitivity analysis, and we will we will done the sensitivity analysis. And on the basis of these information, prepare the charts and graphs, and then after, stress test and audit the model. These all are the steps which are required to be made for the preparation and for the understanding of financial model. Number one, we will consider all the historical result and the assumptions. Number one, consider all the historical result and the assumptions. Number two, prepare, start the income statement. Start the income statement and start the balance sheet. And on the basis of this, we will also prepare the supporting schedules. Complete the income statement and complete the balance sheet. Then after, prepare a cash flow statement. After preparation of cash flow statement, there is a requirement to perform discounted cash flow statement or cash flow analysis. Discounting cash flow analysis. Add sensitive analysis and psychons. Build the charts and prepare the graphs, and then after, stress test and audit such model. So these are the steps which are performed by the organization to prepare the or to build the financial model. Now we will discuss all the steps in the detailed form so that we can understand how to prepare the financial model. Number one, historical result and assumptions. Number one is historical results and the assumptions. Every financial model starts with a company's historical result. Every model is required to be prepared, and it will be start with the financial or with the historical result and the historical assumption of the organization. So you begin building the financial model by pulling 3 years of financial statement and into putting into Excel. Is that if there is any organization which is want to prepare the or which is want to make the financial model, in this case you are required to consider the 3 years of financial data. You are required to consider 3 years financial data and the assumption, and you will put all these financial data and all these assumption into the Excel, so that you can start the preparation of financial model. Is that on the basis of such historical result and the assumption, the entity can prepare the financial models. The next, you reserve engineer the assumption for the historical period by calculating items such as revenue growth rate, gross margin, variable cost, fixed cost, account receivable days, inventory days, account payable days, to name a few. Is that on the basis of these historical data, first you will prepare or you will collect last 3 years previous data, and you will input all these previous data into the Excel. Next, to reverse the engine, the assumption, you will reverse the assumption for the historical period. For the historical period, you will reverse these assumptions by calculating the I. Means on the basis of these historical result, you will calculate the item or historical item such as revenue, revenue growth of the organization, gross profit of the organization, variable cost of the organization, financial cost of the organization, fixed assets of the organization, accounts payable and accounts receivable of the organization, and inventory days of the organization. Means on the basis of this historical result and on the basis of this assumption, the person can identify and he can calculate the time period of account receivable, time period of account payables, and inventory days, fixed cost, variable cost, etc. From there, you can fill in the assumption for the forecast period as hard codes. So these assumptions all are to be used for the purpose of forecast. The next is start the income statement. The next situation and the next word is to prepare and start the income statement. With the forecast assumptions in place, you can calculate the top of the income statement with the revenue. With the forecast statement and with the forecasting assumptions in the place, you can calculate on the basis of such a forecast assumption, you can calculate the you can calculate and you can prepare the income statement with the amount of revenue, with the amount of COGS, cost of goods sold, gross profit, and operating expenses, down to earning before interest, tax, and dividend, depreciation, and amortization. Is that with the forecast assumption, with the or on the basis of forecast assumption in the place, you can calculate the amount of you can calculate the amount of incomes, you can calculate the amount of sale or cost of goods sold, you can calculate the amount of gross profit, you can calculate the amount of operating expenses, and on the basis of this you can calculate the earning before tax and interest and depreciation and amortization, EBITD. You will have to calculate depreciation, amortization, interest, and tax. For the calculation of earning before interest, depreciation, and tax, there is a requirement to calculate the amount of depreciation, amortization, interest, and taxes. So, on the basis of assumptions and for the purpose of forecast, you can calculate, you can you can calculate the top of income statement with revenue, with COGS, with expenses, with cost. For this purpose, you are required to calculate depreciation, you are required to calculate amortization, interest, taxes, etc. Start the balance sheet. After preparation of income statement, the next step is to prepare the balance sheet. The next step is the preparation of balance sheet. With the top of income statement in place, you can start to fill the balance sheet. After the preparation of income statement, there is a requirement to fill out the or to fill in the balance sheet. Begin by calculating account receivable. In the case of a balance sheet, first you will start by calculating the amount of account receivable. For the purpose of this, first you will calculate the amount of debtors and and inventory, which are both function of the revenue and COGS. These these two functions are related to the cost of goods sold of the entity, as well as the account receivable days and inventory days assumptions. Next, fill the account payable, which is a function of cost of goods sold and AP days. is that after the assumptions and forecast, you will prepare and you will start the income statement. And then after, you will start the balance sheet. In the balance sheet, first you will start calculating the account receivable. First we will first we will start calculate the debtors and calculate the inventory, because the calculation relating to the inventory and relating to the account receivable is related to the COGS as well as account receivable days and the inventory days assumption. Then after you have calculate AR or COGS or inventory, then after you will fill all the detail which is relating to the account payable, which is related to the account payable, because the account payable is also related to the COGS and AP date. Next, fill in account payable, which is the function of COGS and AP dates. Then after the preparation of account statement or the balance sheet, the next step is build the supporting schedules. After the preparation of balance sheet, there is a requirement to prepare the supporting schedules. There is a requirement to prepare the supporting schedules. Before completing the income statement and the balance sheet, you have to create a schedule for the capital assets like the property, plant and equipment, as well as for the debt and interest. We said before the completion of income statement and before the completion of balance sheet, there is a requirement to prepare and there is a requirement to create the schedules. These schedules are prepared for the capital assets, the said property, plant and equipment, and for the debt calculation and the calculation of interest. The property, plant and equipment schedule will pull from the historical period and add capital expenditure and subtract the depreciation. In case when the organization preparing the PPE statement or PPE schedule, then the organization will consider the all the relevant data. In this case, the organization will consider all the relevant data which is relating to the property, plant and equipment. And, and for the purpose of this, the entry will consider historical data. When such PPE purchase or it is acquired, so the organization will consider the historical data or the historical period data, and the entity will add the amount of capital expenditure in the value of PP which are relating to the property, plant and equipment, and it will also deduct the amount of depreciation which is charged on such PP. We said for the calculation or for the preparation of schedule relating to the PPE, first the entity will consider historical details or historical period information which is relating to the property, plant and equipment. Is that when the property, plant and equipment purchase, and then after the entity will also add all the capital expenditures which is relating to such a property, plants and equipment. Thereafter, it will subtract or it will reduce the amount of depreciation from the value of such a plant and machine. As for the debt security, it will it will also pull from the historical period and add increase in the debt and subtract repayments. Interest will be based on the average debt balance. In this case, it is also pulled from the historical data. For if there is any organization which is want to prepare the debt schedule, or or if the organization want to prepare the schedule which is related to the debt, in this case the organization will consider the historical information which is relating to the debt, and it will also increase or add if there is the increase in debt, and it will also decrease, it will decrease if there is any repayment of debts. Interest will be based on the average debt balance. The amount of the interest is to be calculated on the basis of average debt balance. Now, after the completion of schedule or after the preparation of schedule, there is the next step to complete the income statement and the balance sheet. In the previous slide, we have discussed that before the completion of income statement and before the completion of balance sheet, there is a requirement to prepare the supporting. There is a requirement to prepare the supporting schedules, which contain the complete information about the PPE, about the property, plant and equipment, and about the debt etc. So after preparing the supporting schedule, now there is a next step to complete the income statement and to complete the balance sheet. The information from the supporting schedule, the information from the supporting schedule complete the income statement and the balance sheet. Is that by the use of a supporting schedule, now the organization will complete the balance sheet and complete the income statement of the organization. On the income statement, depreciation, which is relating to the property, plant and equipment, will be considered, and the amount of interest which is relating to the debt will also be considered. Is said in the case when the organization is preparing the amount of income statement, then the entity will consider the amount of depreciation on the property, plant and equipment, and the organization will also consider the amount of interest on these debt schedule or on these debt funds. From there, you can calculate earning before taxes and the net income. On the basis of these data or on the basis of such income statement, the organization can calculate the earning before tax and interest. On the basis of income statement, the organization can easily calculate the amount which is earning before tax and interest, and it can also calculate the amount of net income. On the balance sheet, link the closing property, plant and equipment balance and closing debt balance. In the balance sheet, the entity will put the closing balance of property, plant and equipment and closing amount of loans. Shareholders' equity can be complete by pulling forward last year's closing balance, add new income and the capital which is raised, and subtract dividend or the share purchase. In the case in the case of completion of balance sheet, the entity will also put or the person will put the amount of shareholder equity, the amount of shareholder or the amount of equity from the last year. And if there is any capital raised, if there is any capital raised during the year by the issue of share or by the any source, then it should be included in this previous year balance. And if there is any profit, then it should also be increased. And if there is any loss or if there is any payment of dividend, if there is any payment of dividend or there is any redemption of share, then the amount of shareholder equity should be reduced. Is that for the completion of balance sheet, the shareholder fund will also be considered. In case if there is any redemption of shares or payment of dividend, then the shareholder fund will be reduced. And if there is any capital raised during the period or there is any income, then it should be added in the value of or in the amount of shareholder fund. And on the basis of this, the balance sheet and the income statement of the organization will be prepared. On the basis of this, they can complete their income statement and the balance sheet of the organization. The next step is build the cash flow statement. After the completion of income statement and the balance sheet, there is also a requirement to prepare the cash flow statement. With the income statement and the balance sheet complete, you can build the cash flow statement with the recognition method. Is that after the preparation and after the completion of balance sheet and the profit and loss account, the entity will build or the entity will prepare the cash flow statement. And such cash flow statement is prepared by the organization with the recognition method. Is that it will be prepared on the basis of recognition method. Start with net income. Start with the net income. It will add back the amount of depreciation. For the preparation of cash flow statement, first we will take or we will consider the net profit. In the net profit, in the amount of net profit, there is a requirement to add back the all the non-cash items. For the example, there is a requirement to add back the amount of depreciation and amount of amortization because these all are the non-cash items. And for the preparation of cash flow statement, there is also a requirement to adjust the working capital to adjust the change in working capital. Is that if there is any change in working capital, then it should also be considered for the preparation of cash flow statement. Adjust for the change in non-cash working capital, which result in cash from the operation. And the cash which is used in the investing is a function of capital expenditure in the PP schedule. Is that the cash which is used for the investing activity. The cash which is used by the organization for the purpose of investment function, then it is to be considered as investing activity. Before there is any capital expenditure which is made by the organization for the purchase of property, plant, and equipment, or for the purchase of any assets, then it is to be known as cash used in investing activity. Then it should also be considered for the preparation and for the the cash flow statement. And the cash flow from the financing. The cash flow from the financing is a function of assumption that were laid out about pricing the debt and the equity. The cash from financial activity is a function or it is considered those cash which is arise from the debt and the equity. So after the completion of income statement and the balance sheet, there is a requirement to prepare the cash flow statement. For the preparation of cash flow statement, there is a requirement to adjust the amount of net profit with the non-cash items, and there is a requirement to adjust the change in working capital. The next step is perform the DCF analysis. Means after the completion of financial statement means after the completion of income statement and the balance sheet and the cash flow statement. Now there is a requirement to perform the discounting cash flow analysis. There is a requirement to perform the discounting cash flow analysis. When three statement model is completed, when the three statement model is completed, is that when income statement, balance sheet and the cash flow statement is completed, now it is time to calculate the amount of free cash flow. Now it is time to calculate the amount of free cash flow and perform the business valuation. When the income statement, balance sheet, and the cash flow statement is prepared by the organization, now there is the next step to calculate the amount of free cash flow and perform the business valuation. The free cash flow of the business is discounted back to today at the firm's cost of capital. The free cash flow of the business, the cash flow of the business is required to be discounted, is required to be discounted at the firm's cost of capital so that the organization can calculate the present value of such cash flow. For the example, there is any organization which is calculate the amount of cash flow which is arise into the near future. So in this case, the entity will discount it with the opportunity cost or with the required rate of return so that it can calculate the discounted cash flow or the today's value of these cash flows. So the performance of the DCF analysis is also very much important to know about the discounted cash flow. It is to be done by the organization after the completion of a three statement model. Now, the next step is add sensitivity analysis and scenarios. Now, we will discuss or after the after the calculation of discounted cash flows, there is a requirement of sensitivity analysis. Once the discounting cash flow analysis and the valuation section are complete, when the valuation and the calculation of discounted cash flow analysis is completed, then it is time to prepare or incorporate sensitivity analysis. Now, after the completion of discounted cash flow analysis and the valuation section, there is a requirement to incorporate the sensitivity analysis. Means now there is a requirement of sensitivity analysis. The point of this analysis is determine how much the value of the company will be impacted by the change in underlying assumptions. Is that on the basis of such analysis, on the basis of such analysis, the organization can determine or we can determine how much how much the value of company how much the value of the company will be impacted how much the value of the company will be impacted by change in underlying assumption. Is that by such underlying assumption, what will be the change in the what will be the change or what will be the impact of change in underlying assumptions. This is very useful for assessing the risk. This is very useful for the purpose of assessment of risk of an investment or for the business planning purpose. This is very much important for the calculating or for assessing the risk of the organization, risk of the investment, and the business planning purpose. So this is the next step, or this is the one of the best step in the relation to the financial model and sensitivity analysis. The next is build graph and charts. Build graphs and charts. After the completion of three statement model and after the completion of DCF analysis, there is a requirement to prepare the chart and the graph because in the case in the case there are in the case of financial modeling, there are the many of the results or many of the data which can be presented in the bulk quantity. These results cannot be presented in the bulk quantity. So for the clear understanding or for the clear communication of the result is something that really separate good from great financial analysis. For the clear communication or for the clear understanding about the any of the result, there is a requirement to prepare the graphs and the chart. Because on the basis of graph and the chart, the user can easily understand the process. the user can easily understand the process. The most effective way to show the result of the financial model is through charts and the graph. On the basis of charts or on the basis of graph, the entity can show the results of financial model. Most executives don't have the income, don't have the time or patience to look at the inner working of the model. So the charts are more effective to present the working of the organization. Is that in the case of organization, the higher authority does not have the time to check each and every point or each and every working. So on the basis of chart, we can present the situation, we can present the situation and we can provide the information about the inner working on the basis of these graphs and on the basis of these charts. So the preparation of charts and the preparation of graph is the very much important to present the result, to present the result very clearly and to provide the information easily and within the less time period. So this is the next step. This is the one of the best step of the financial model. Now the next step is and the last step is stress test and audit the model. Stress test and audit the model. After the completion of each and every process of model, there is a requirement to audit the model. After the completion of each and every after the completion of each and every step of the model, your work is not yet over. Means when all the all the activities of the preparation and the completion of model is done, but now there is the another step. It is time to start stress testing. It is the time to start the stress testing to see if the model behave as expected. Now it is a time of testing and now there is a requirement to see whether such model is performing the activities, whether such model is performing the activities according to the expectation or not. It is also important in this case, it is also very much important to use the audited tools. In this case, there is also the requirement to use the audit tools to make sure whether it is adequate and use the Excel formula for the all working problem. Is that for the purpose of auditing, there is a requirement to use the audit tool and there is also requirement to use and for the purpose of audit tools there is a requirement to make sure that it's adequate and Excel formulas are properly working or not. So in that case, after the completion of such modeling, financial model, there is a requirement to perform the stress test to understand whether the model doing the work according to the expectation or not. For this purpose, kindly use the audit tools and to be sure that whether it is adequate or not. So this is the last step or the last function or the last series of the financial model. Means after the completion of this process, the financial model will be completed. This is the graphs or how to show the cash flow and the cash balance, because in the case of organization the higher authority does not have time so that he can check or he can reconcile, he can calculate or he can understand the overall process. So by the way of chart we can present by the way of chart we can present the position of the business or the position of finance to them. So on the basis of this, we have completed part 1 of the financial modeling, in which we have discussed in which we have discussed what is the financial model, and we have discussed how to prepare the financial model. How we will prepare the financial modeling, so means the steps of preparation of financial model. Thank you so much for watching this video. There are two other parts of this topic. Kindly consider these two parts also, so that you can understand this method or this concept completely. Okay, bye bye and have a nice day.